Welcome back. You're with us here on Bazaar Morning Call. Gautam Sinha Roy, Executive Vice President and Fund Manager at ICICI Prudential Life Insurance, and Ankit Agarwal, Equity Fund Manager at UTI Mid Cap Fund, are joining us. Gentlemen, great to have both of you here. Prashant this side. I want to, before we start talking about mid caps and where there is value and what is looking good, just for our viewers, once again put that table up, which tells you what has happened in the last 7 trading sessions. This is, change on the NSE 500 from the 14th of December. And it's been pretty widespread. I mean, the damage itself has not been large. Only 12 out of 500 names are down more than 20% in these 7 days. And the other kind of percentage damages on your screen, 145 stocks down between 10 to 20% and 300 odd stocks down up to 10%. But only 30 higher, point to point, December 14th to yesterday's Friday's close. So broad pressure is what we have seen. With that kind of backdrop, if I can kick off this conversation, first I want to ask, and I think Gautam and Ankit, many are still wondering whether there was one kind of dominating driver for the sell-off that we saw over the last couple of days. Briefly, Gautam, and then I'll come to you, Ankit. Gautam, was there one reason which led to this kind of a panic?
Good morning, Prashant. Good morning, Sonia. Festive wishes to your entire team. I think of late, the liquidity situation, both from domestics as well as the foreign flows, both have sort of softened coincidentally. And that's something that was in the construct that was waiting to happen. And that combined with domestic liquidity, domestic HNI or retail liquidity also softening, could have had a role to play. But, ultimately the construct this year, if you see, has been that growth stocks have suffered. Why have they suffered? The biggest reason is the Fed fund rates, which have been hiked almost like 400 basis points, which is a very unprecedented sort of a year from that perspective. So the shift away from growth stocks has been a phenomena which has been there through this year. And somewhere for a large part of this year, Indian stocks have been supported by the domestic liquidity, which of late we have seen signs of easing. And that is what is reflecting the charts that you showed.
Gautam, I spoke with S. Narain on the mutual fund side, who said broadly, I mean, this is a broad take, that mid caps and small caps, generally, there is the room for valuation. This was about 2 weeks ago. Room for valuation comfort perhaps is a little low as we head into the new year. Large caps still provide that in pockets. How would you... Now, that's a broader kind of way to look at things. There are obviously bottom-up opportunities, but would you agree with that, Gautam?
On an absolute basis, Prashant, yes. Would you say that mid-caps are attractive today versus large caps on a very absolute basis from a near-term perspective? Probably not yet. That would need a little bit more of a correction. But if you think of it from more of a longer duration perspective, so as you look at India, India is clearly the fastest growing, one of the largest economies in the world. It's a very strong, place to be in for an equity investor. You have a very large GDP and it's growing at the fastest clip in the world over the next 5 years. And which set of stocks are most levered to this growth opportunity? If you ask yourself, the obvious answer would be mid caps. And within mid caps also, you are seeing emergence of new sector after sectors. I think chemicals was one sector which emerged 5-6 years back, still going strong. We're taking market share from the rest of the world. Then electronics led by PLI manufacturing, that's another sector which has emerged. Many of the domestic facing sectors which have not done well historically, like QSRs, hospitals, the broader retail space, I would say, they have also started doing well. In fact, now you have quite a few set of companies which look very good in diverse sectors like apparel, footwear, diagnostics. So, it's a very interesting set of companies which have come up in the mid-cap space. So I would suggest that if you have a long enough duration, which is maybe 5 years or more, you can continue to invest in mid-caps with a selection of stocks which will be very important. I think the selection part here today is more important because the other piece which is happening globally is that definitely there are growth headwinds, right?
Yeah.
A lot of this headwinds is driven by interest rate hikes too and other factors. So if you get your growth call right, then I think you will still find opportunities in mid caps, and especially if your duration is 5-7 years, definitely a good opportunity to invest.
Okay, in fact, let's get Ankit Agarwal, who manages the UTI Mid Cap Fund, to join into this conversation. Ankit, good morning. I noticed, in your top 10 stocks in your portfolio and your fund, you have a lot of financials. So whether it is Federal Bank, the City Union Bank, there is Shriram Transport Finance, Cholamandalam. What do you do at a time, for example, with City Union Bank, right, where there are issues like the RBI divergence in asset quality, etc.? At a time like this, do you keep the faith in these names? And considering financials have been assuming leadership, do you stick to these stocks?
Yeah, good morning, Sonia, and season's greeting to your viewers. I think, without talking stock specific, from a broader financial and especially on the mid-sized financials, you're right, there was the valuations had significantly come down from a lot of the names. And, we were seeing improvement in credit quality and asset quality improvement that led to these valuations moving up. Now going ahead, it would be more about, what is the sort of revival that we're seeing on the SME side, specifically with some of these names, how the cycle on the CV side moves up. I think those will be the drivers to watch out for. I think the play from here would be clearly on how the credit growth plays out in some of these names to support the valuations that they have come in. I think the easy trade of valuation catching up probably, to some extent may have played out.
Ankit, among the other underperformers in your portfolio have been some of these mid-cap cement names. JK Cement, for instance, it's lower this year. What are your thoughts on this sector as a whole? Because a lot of these cement players are acquiring assets to grow their capacities. A lot of them are adding fresh capacities. A lot of them eyeing ancillary businesses like paints, etc. as well. In light of this and the impending, big entry of the Adani Group, how do you really play this theme, and how do you bet on this space?
I think from purely demand perspective, we do see still some legs there, with both real estate and infrastructure sort of cycle picking up. I think what really impacted companies this year was significant amount of commodity pressure that they saw, and therefore EBITDA per ton, we have seen a significant decline happening this year. I think the play there would be some amount of normalization in commodity costs, which could lead to some amount of this EBITDA per ton improving. And with growth coming back, you could see some amount of mean reversion happening in valuations also. So I think the clear play over in the cement space would be improvement in EBITDA per ton, driven by largely commodity costs sort of easing off as you see some amount of slowdown even globally.
Okay.
Ankit, is there, are you across a range of companies and you would speak with your portfolio companies? Do you sense over the last, say, month and a half, 2 months, some amount of slowdown which is starting to creep in? It could be post-festive, but could be more, a bit more structural in nature. Any sense on that, Ankit?
I think there is some of the companies which are more export-driven. We are seeing some amount of caution in their commentary. Although the current pipeline, etc., still remains fairly good. And probably, the impact of slowdown would be more visible in a quarter or two. And therefore, companies are becoming more cautious. But we are not seeing any broad-based structural slowdown. I think some of the drivers which were helping some of the companies, whether it's more domestic manufacturing or whether, it's more export out of India, the benefit from, global supply chains shifting, etc. I think all those trends do remain intact, but maybe some of the export-driven companies are becoming a little bit more cautious in their commentary.
Okay. Gautam, one last question to you. You have identified a couple of new sectors. I mean, you talk about how new sectors like electronics, chemicals, hospitals, hotels, QSR have emerged. So do you see potential here? And is this a good time to buy, or do you think you can get a better opportunity over the next couple of months?
I think, Sonia, for many of these sectors, it's a very long-term structural opportunity. Just like in chemicals, we started seeing that opportunity emerge maybe in 2014 or thereabouts. And we have seen really large scale, large cap companies emerge out of the sector. So what happens is that one of the driving factors of this is essentially formalization of certain sectors, business shifting from informal economy to the more formal economy, be it in hospitals, be it in dining out and all those. That is a big driver of change in many of these domestic facing sectors, I would say. And hence, I believe that many of these opportunities are more structural in nature. They would have legs probably for 5 years, even more. And we'd see, and in hospitals especially, we have already seen a large cap emerge. And in many of these sectors, we'll continue to see that happening again and again, because the construct of India always remains the same, right? It's a very large market. And if you have a tailwind of formalization, if you have a business model which is in place, if you have unit economics in place, then the opportunity to create wealth in individual sectors is very high. We have seen that in jewelry sector, for example, earlier within the entire retail gamut. So why can't that happen in many other pieces of the overall retail pie?
All right, Gautam, Ankit, thank you so much for joining in and giving us your thoughts, as well as speaking on a wide range of sectors as well. The underlying theme being that India is a large market. You get the growth call right and get right companies. And in the long term, of course, you are likely to see an outperformance coming in from the mid caps as against the large caps because of the growth runway that these companies have. Wish both of you and your teams a very happy new year as well, 2023. May you guys make a lot of wealth for yourselves and the investors.